All right, so we had a good morning trading the S&P futures. This last trade we did was the a Gartley pattern on the S&P E-mini futures. We could just see the X, A, B, C, D point, and we worked that with the guys. But let's take a look at some currency markets, then we'll call it a morning. All right, I have some stuff we're doing right now for the trade signal service. Let me just turn this off. Okay. So what do we have here? We have our Ninja Trader. We have the GBP USD. And overall, we have a large range that we have to respect. We have a swing low here to a swing high. We got this whole range. So this right here is a definite support below. And the one thing we want to keep an eye on, and as I fudge through these arrows and stuff, is the market had its rally up to the market high and then had its first pullback. All right, that's going to start to establish the basis for a pattern. But the main thing was we had this rally right here, this rally on the 4-hour chart. Market had no real big pullbacks, and the first pullback came right in this area. From that point, market gave another test up and now is starting to pull back towards this area. So we see the basis for a harmonic pattern and actually a bat pattern. So we're going to go through and just remove all this data, and we're going to put the first levels of information in here. So what I like to do is a couple of things. All right, we do a couple of things. We got your low to high. All right, we're just going to change out these other balancing points to this. Now, the first thing we want to watch is that first pullback from the market high. All right, that first pullback from the market high will determine the type of pattern we're going to have. So we have your rally, and then this right here, if we came down this far, then that would have set up a Gartley pattern. But the fact it came between a 38 and 50% pullback, that gave us the information that we're going to be possibly having a bat pattern if we now can start to come down here, which we are. All right, so we got that first level in there to watch. And then from the market high to that swing down, we want to see 38 to 88% retracement up, which that's right there. It's right around the 50 to 75% move back up. So we have that criteria already included. All right, we have that in there. I could just, let me just see if I could just take this out right here. Actually, let's just remove that. Okay, so what we have to start is your low, and your low is going to be the X point. Your high is going to be your A point. Your first pullback is going to be a B point, and then your move up is going to be a C point. Well, the one thing that we do in harmonics is we're always looking for D. Always looking for D. You always want to be on the lookout for D. That's where everything comes together as a D point. So we actually set up a trade here for the trade signal service for the hands-free side, but we want to do this since we're in the live room. It just got signaled. So you got your X to A to B, and then your B to C, and then down towards that D area. Your risk point is going to be down below your X point. So you put it right below your X point. You know, everybody has their own interpretation where the risk should go. All right, so let's just make this a flat, solid line. So right in here, you're hitting that 886. So with the bat pattern, your X, A, B comes within that 38 to 50%. Then your BC, ABC, which is that retracement up from the move from A to B up, 38 to 88%. And then you have that drive back down. So this drive back down right, will give you that 886. We have other criteria in here, but I'm just going to basically just want to point out this area right here. So X, your XAD is 886. Hold on one second, gang. And your BCD, I'm sorry, your BCD is going to come in with a 1618 to a 2618. Let's just see if we could throw that in there. I already have the ratios from my scan, but I'm just going to put it in there anyway for you so you could see it. So let's just make this a 261 or 262, okay? We'll get rid of all this little clutter here. So you could see the data comes in. Here's a 1618, here's a 2618. So it comes in within that criteria. Most of the time it does. That's why I really don't focus so much on it on this particular pattern right here as we're working. So right here is your D point. This is your buy area. A couple things you want to look at. All right, couple things you want to look at when you're looking at entering into a harmonic pattern is right here. So if we take it to the lower time frame, you could have this. All right, that little push down, and then your oscillator, which is this below, would look something like this. Let me see if I can make this here. It would come down, make a new low. It would come up with it and make a higher low, forming a divergence type of pattern. That's one way to look into entering on the harmonic pattern. You'd enter in on a shorter term, or you basically just go straight and enter right here with your risk right below X. That's pretty mechanical. If you want to look for other ways of entering, that's one way. The other way is you got your push down, push up, push down, right? Push up, push down. You'll have your three drives, one, two, your three drives down, and that equates also to Elliott wave if you think about it, right? Here you see these multiple pushes down. This is basically 1, 2, 3, 4, 5. This is in a solid trend down, and now we're getting that little flush into support. So I would like this as a buy area. Other people, you can buy here partials, you can buy here partials, you can buy here partials, and keeping your risk down below for the entire trade. Targets to the upside, you're looking at roughly a 38% and then a 62% and then 100% of the swing. And what do I mean by that? Okay, let's just take this here. And let me just adjust. Let me just adjust this. So we're going to look at 38%, 62%, and you got your 100%. Okay, everything else, we're just going to remove that. Okay, remove all this other stuff. And everybody has their own targets and how they like to play it. But essentially, your target, first target from your 886 will be 38% from that C to D leg back up. Some people do it from A to D. It's whatever you want. I like looking at from C to D because that's a nice solid move right there, and I'm looking for the retracement up from that swing. So 38%, 61.8%, and then 100%. There's different ways to go about it, as we discussed in our prior educational side in terms of trailing stops, but just mechanical basis, that's what you would look at. So this market can come all the way down here and still say valid. Unless it breaks the X point, it's still a valid pattern. So it may take time to play out in here. I did it on a very, very small size, so that way we would not get hurt. God forbid it gets stopped out, but you're not going to make a fortune either on the way up. It just is what it is. You're going to keep keeping this as a 1%. Actually, let me see. I'll tell you exactly what the risk is. The risk is we entered 777 stop loss. We got about a little less than 1% risk. Okay, a little less than 1% risk on the trade. It's a 4-hour chart. So you also have to determine what your risk factor, what your risk profile is when you take a trade. Some people like 1, 2, 3%. I prefer to keep it lower. So what we could do is I'm lowering the time frame of the chart. So if you had a 4-hour chart, you could lower it down to an hourly. Right? Take a look at the hourly, see what's forming. Maybe you get a little bit of a buy divergence down here on your oscillator. Take a 30-minute chart. All right. Another way how to go about this. All right. Another way how to go about this. Get rid of your line. Well, keep the text. Get rid of the arrow. All right. Keep the line. Okay. The other way, which is a safer way how to do it, is looking for your a reversal point. So now you've pushed into the zone. That's where it mechanically triggers. But other ways to look at it, you would look for a shift in momentum. So a shift in momentum, which means the move up would be greater than the last move down. You see that? And then you're looking at a retracement down from that point. That will be a safer play because you're not buying into the move down. You're waiting for it to shift. If you wait for it to shift and take out the prior swing high, you're taking out these prior swing highs. That's kind of telling you that we're getting a bit of a shift. Not so much that one right there. I'm sorry about that. I'm a drawer. I like to draw. All right. So you're getting your move back. What you're giving away is this distance from here to here, but you're also allowing, you're not going to take a big stop on the way down. So the pullback down, you would buy into. So you would wait for a shift of momentum, and then you would start the Elliott process up. All right, so you got your low would be in place. You got your rally, which is a shift in momentum from down to up. First pull back down, then you would start looking at this in terms of how Elliott would symbol it. So you got your 0. You got your 1. 1. 2. Okay, I'm going to stop right there because then you have your 3 and 4. But if we're looking at this also in terms of Elliott or harmonics, you have your A to B, right? You have your A to B, C to D. This would be your alternate wave equality right here. So you can buy it on the way down on a larger term harmonic, wait for it to shift, or wait for it to shift, and then that pull back. Then you have the beginning of an Elliott wave, 0, 1, 2, 3, 4, 5, or A to B, C to D, which is what we use in the format anyway for harmonics and for Elliott. So different ways to skin a cat. The main thing is that you're identifying first the pattern. All right, you're identifying your pattern, and you're identifying your risk points. Your risk points are down here. Your initial risk points are X. So no matter how you twist it, you can enter in on a shorter term or a larger term. Just keep in mind, when you're entering on a shorter term basis, like we talked about, your risk would be on a shorter term basis. Let me just point that out one more time because I didn't do that. Let's just say hypothetically, okay, you got into the market. Here it is. Let's just say you had, okay, this is the last swing down. Then the market swings up. Okay, shift in momentum, then comes down. Your risk is down here. You see, you can minimize your risk using this higher time frame, but entering on a lower time frame. So you would be working that 4-hour chart, but entering on a 30-minute chart and waiting for that shift. I personally, it just depends. I like this right here as a 1% risk. I like the area. It can come down against us. We could always add a part of it. Not a problem with that. But if you want to be more conservative, you let this develop an entry area, and as the market moves up, we basically will start looking at swing lows, and developing that trend line that will be formed going forward. So good area to watch, okay, right now. And you could enter it a myriad of ways. Either put a little bit of risk, wider stop, or wait for it to turn. And then when you get this turning point, you get some confirmation. You could look at the distance between here and here. Let's just say right here to here. That'll be, I don't know, 50 pips in here. All right. Then you can adjust it from that point. So many different ways to skin the cat. Rock and roll. Let's have ourselves a great rest of the day. And we're coming into the end of the session. Let's take a look at the S&Ps and see what they're doing. All right, they're still working their way down. On that earlier harmonic pattern, they're still working its way down for your targets down here. So, and this would be laid out as such. I know we don't sometimes do that, but here is your X, A, B, C, D. All right, and that was the trade we looked at earlier. All right, rock and roll. Let's have a great